Today is April 2 and the market is closed, but we can still look at the options data for the Friday that it closed at. So today, Sunday, weekend, but we want to prepare for the upcoming week. So we'll look at that data on the three indexes, their options tape, and see where we're headed. Okay, so without further ado, here we go. As you see, I've filtered out only the options for this week that expires all within April 6th. You can do that by coming here at this this filter tab. Is right here. You click this button here, and over here you can check mark the dates that you want. So here we are at we see some of these 418 417 calls. They're it does not they look like they're call spreads being sold, and that makes sense because 417 418 is all the way over here, which is a resistance of this year, the same range when we got here, I believe February 2nd, right? And so for us to make that in 1 week on Friday, very unlikely, because we are overbought already on the stochastic oscillator. It has rallied quite a bit, and so the stock market does need to take a breath at some point. So that's probably why they're selling a call spread, and they don't believe it's going to break this level in by this week. Okay, so that's the 1222, and then let's take a look at these big numbers at 355. We have a lot of these just 5 minutes before the market closed at 355. Here you see these April 6, 7,500. Over here, they bought the 400 puts and sold the 400 calls. Same here, they bought the 406 puts and sold the 402 puts. And so you see these large numbers. So if we look at the April 6 ones, let's look at the chain and make sure these are actually what the volume is. So those are 400 at the 400 strike price, the major psychological level. And what we're also making sure is that these the volume here is greater than the open interest. So we know that these options are being opened and not closed. So so this one looks like, yep. So this one's also higher. This is 19,000, and here's the open interest is only 6,000. So these are all opening. These are new trades. So this one, it looked like it was buying the 400 puts and then selling the 400 calls. And if you were to analyze it, you will see that it is a short position, that as the price, which is where right here, we're at 409.75, as it goes down, it will increase in profit. This is our profit loss line here above the zero, and anything below, that's a loss. So as it goes up, it will be at a loss. So this is definitely a short position. So over here, you see that here they did 7,500 of these contracts, and so same thing here. These other ones. Okay, so with this S&P 500, it looks like it is the unusual options are betting that it will be going down for the week by April 6th. Okay, so let's take a look now at the NASDAQ. Okay, so this one is also overbought on the stochastics. We could see that it did break its yearly high here already. We are above that, so that is a good bullish sign there. And so let's take a look at the options. Again, this is filtering out just for this week, so we aren't distracted with anything else because there's many other options people could be buying or selling to hedge themselves, especially using these market index ETFs hedges, and it really could get confusing and difficult to decipher what everything means. So here we have a very large amount of put buying here on April 5. This is bearish here. You can see that 5,000 contracts here, paying quite aggressive, paying $2.29 when the market was going for all the way at 2.24. They were overpaying. You see that 225. So they're very aggressive to get these in. So it's definitely quite bearish. Here we have these April 5s buying the 325 calls and selling the 320 calls. 3,000 of these contracts here. Right? So what does that one? Well, let's take a quick look and make sure these are also opened. They're at April 5s, 325s. So April 5s is 3 days away. So that's the 325s here. Okay, so all right, so yeah, this is greater. The volume is greater, 10,000, than the open interest at 9. And then the 320s is also greater. Okay, so that looks like this one is buying the 325s and selling the 320s. So if we were to analyze that, buying the 325s and selling the 320s, and we take a look at that trade, it is also a bearish and short. So it's selling the short calls. So it's a call spread, selling a call spread. So it goes up. Profits go up if the price actually goes down. So you'll see here again. So let's see if what else is interesting and unusual here. Also here at 348, close to market close, another one of these buying the 318 puts and selling the 313 puts. So also a bearish vertical spread. Okay, so that's also bearish. And this is the trade we just saw. There's just more contracts. So this is this and that. They're the same strikes here. Okay, so yeah, so I guess the NASDAQ, it's for this week is projected to go down. Okay, and it does make sense technically because of, again, this overbought situation. Okay, and now for our last index, let's take a look at the last one, which is the Russell. Let's see what we have. Let's make sure we turn on all the other dates. April 5s and April 3, right? So then let's take a look. Okay, so also buying these 170 puts, bearish. Let's see. We have also this 11 at 11:45. You see here buying the 175 puts and then selling the 172 puts here. That's also bearish. And anything else? Let's see. We can see here lots of these 170 twos here and 170. You also see something here at 359. I think this is one of the interesting ones here. 359, just like basically 5 seconds before the market closed, this order came in at 359 and 55 millisecond, right? Actually, yeah, millisecond. So, no, that's not millisecond, just seconds. 359 and 55 seconds. So they were selling the 170 puts, they were buying the 175 puts, and then they were also selling the 182.5 calls. So what they were doing with this was actually selling the calls to get a credit to buy the 175 put vertical spreads. So that's interesting. It's a nice trade here. You can see on April 6th. Let's make sure also that this was a opening. Yep, so here it is. The 175s are here. The volume is greater than the open interest, and the 170s are here. Also, volume is greater than the open interest. Okay. And then the 182.5, which is here, 6,800 of these in the volume, and definitely lower than the 786. So this is open. So what they did was they took this 182, they sold this call. They don't think it's going to break 182.5, so they're taking that credit, and then they're going out and then buying this vertical spread on the put side, which is then actually going to only cost them $2, a debit of 2. So it doesn't cost them very much, except you do need that buying power to do a trade like this. So this is the trade. You'll see here that what they're essentially doing is they're not at much of a loss. Even if the Russell does go up, they're not at a loss if it's not going to break 182 by expiration date. Let's kind of expand this so we can see it a little bit more clear. Here it is. So here it is, because there's at 182, this is the mark where their losses start to increase if it breaks 182. Otherwise, if it goes down, the profits will continue to increase. And so 182 is, I believe they are giving this index a little bit more room to go up because it is, I think because it is closer to, at the weeklies, if we look at the weeklies, it's actually not very overbought. So that's could be why they're giving a little bit more room for it to go up on the weekly. If you look at the weekly, because if we look at the weeklies on, let's say, the NASDAQ with the Qs, you can see it actually is also overbought even on the weeklies, and also the SPYs. We are getting close there, but NASDAQ is definitely overbought. So with the Russell, as long as it doesn't break that 182 here, and it kind of, I think that's what they're not going to be at a loss with this interesting trade where they're selling their call spread. I mean, they could have a lot of shares in this, and they're just selling these calls like a call spread, like a covered call, and then they're just collecting that credit just to buy and hedge themselves on the way down. And if it doesn't break that 182, then they're also not at a loss at all. So that's how it is with this. Okay, so again, this is the top. It will probably go down, but it won't break 182. So that's the analysis of these three market indexes. If you found value in this video and you like it, please give us a thumbs up and subscribe and hit the bell icon, and you'll be notified. We'll try to do more of these weekly market analysis on the weekends. Take care and good luck this week.